The Banco Mais case C183 of 13, deals with the partial exemption rules as they apply to hire purchase sales. The point is that a hire purchase company is essentially a financial institution which lends people money, but for various reasons it's legally and technically involved in the sale of the goods that are the subject of its finance deals. Take the sale of a car. A car dealer has found a customer who wants to buy a car on hire purchase finance. The car dealer has purchased the car as a supply of goods and it's standing in the car dealer's showroom. The customer signs some papers, and although the car doesn't go anywhere near the HP company, the customer just drives it home. Legally speaking, the car dealer will have sold the car to the HP company, and the HP company will have sold it on to the customer. This is important if the customer stops paying. The car belongs to the HP company, which will then repossess it. Of course, what the HP company is really supplying is the finance, a loan of money which the customer will pay finance charges or interest on over the term of the contract. So the HP company buys and sells the goods, but that isn't where it makes its money. It probably buys and sells for exactly the same amount of money. It's the car dealer who makes money on the car, and the car dealer who decides to give discounts or incentives on that sale. The HP company has no influence over the sale, apart from presumably imposing some conditions to protect itself from likely bad debts. The separate finance supply is exempt. Bear in mind that a hire purchase sale is treated as a supply of goods at the time of delivery of the car, so the output tax on the capital value of the car is due immediately, but the tax points for the exempt supplies of finance charges are spread over the contract term as each monthly payment falls due. Distinguish that from a leasing supply, where there's no intention that the goods will ever become the lessee's. In that case, there's a single supply of services and it's all taxable, and each monthly rental is VATable in full as it falls due. The difference may or not always be obvious, but it is an important one, and it depends on the wording of the contract. Let's put some figures on all that. If the car is bought and sold by the finance company for €10,000 plus €2,000 in VAT, and the finance charges amount to €4,000 spread over 4 years, then there's no doubt that the €2,000 of input tax is 100% deductible when it's incurred. There'll be €2,000 of output tax to match it on the same return, because the input and the output happen at the same moment. The question is how the figures affect the recovery of overhead input tax by the HP company. The directive sets out different ways of dealing with input tax recovery, where a business makes some taxable and some exempt supplies. The standard method, the default method, is turnover-based, taking a proportion of taxable supplies divided by total supplies. That doesn't work simply with HP because the tax points for the finance and for the car fall in different periods. But if we make the simplifying assumption that everything happens in the same period, the recovery percentage on the figures I gave in my example would be 10 over 10 plus 4, or 72%. That's a pretty good recovery rate, particularly when you consider that the HP company is in reality a money lender, an exempt business that wouldn't expect to recover very much input tax at all. It's just the curious legal technicality of an HP sale, which means a large taxable value goes in and out on its VAT return in an instant, distorting the picture to make it look like a much more taxable activity. The Banco Mais case involved an attempt by the Portuguese authorities to impose a fairer recovery on an HP company after the event. The company had operated the default turnover-based method and was very happy with the result, but the authorities raised an assessment to disallow most of the input tax on the bank's overheads. The Court of Justice looked at what is now Article 173(2)(c) of the Principal VAT Directive, which allows member states to authorise or require the taxable person to use different partial exemption methods. It says nothing about when that authorisation or requirement has to happen, so presumably it can be done after the event. The different method is simply supposed, according to the directive, to make the deduction on the basis of the use of the inputs to make taxable supplies. That's a very simple description of a very disputable procedure. However, the Court of Justice was satisfied that the standard method gave a misleading result. The overheads of this financial business were not really used to sell cars, so it was open to Portugal to require them to do something fairer, even by raising a retrospective assessment.